Hi, I'm Becky East of Noble, the Credit Coach Queen. I would like to go over some credit education with you today so that you can be more informed about what it takes to buy a house these days, about credit and how it all works, and all the little secrets that nobody wants you to know about. I would like to go over some simple definitions of things that show up on a credit report so that you understand what you're looking at every single time you look at your credit. As far as lenders are concerned, there are 3 different types of loans out there. There's FHA, VA, and conventional loans. FHA is the most popular type of loan that's out there these days. So that is the one that we like to go over with our clients. As far as FHA is concerned, they require 3.5% down, a 620 to 640 middle credit score, 41.5% debt to income ratio, 2 years employment in the same field, and 3 open lines of credit for 12 months or more. What does that mean to you? What that kind of means is that whenever you go to try to purchase a house, say you make $2,000 a month, you can take about half of that and use it towards a house payment if you choose to. That would be about $1,000 a month. At a 10% interest rate, that means that you could possibly get somewhere around a $100,000 house. If it's 3.5% down that you're required to have as a down payment, then that means you need to have about $3,500 saved while we're doing credit repair. So the end result is that you get what you want and you'll be able to get that dream home that you've always wanted to have. Let's start going over the different scoring models that gets a credit score. There's a FICO scoring model and then there's a Vantage scoring model. There's so much stuff out there, who knows what's what. But with the FICO scoring model, it's what mortgage brokers and car lots use to actually pull your credit to get you approved for a loan. With the Vantage scoring model, that's everything that we find online. Credit Karma, FreeCreditReport.com, Identity IQ, Smart Credit, all of these companies have different scoring models. That means they come up with the credit score a different way. So, for instance, if you pull up Credit Karma, sometimes the scores are not going to be the same as if you went to a bank or a car lot. It's just a general idea of what your credit score is. And that can be kind of confusing. Sometimes people go to finance something, you go into Credit Karma, it says one thing, and then when you go to have your credit pulled, sometimes the scores can be either 50 to 100 points higher or lower than what you thought. The reason for that with car lots is sometimes they have credit scores that weigh more heavily on how you've paid for your car, where a mortgage company sometimes weighs more heavily on what you've done with mortgages so far. And so that's how the different scores come in. Let's talk about the FICO scoring model and how that works. And as far as FICO is concerned, 35% of your credit score comes from payment history. That means, do you make all your payments on time? 15% of your score comes from credit history. How long have you had something open? The longer the better. When you close out credit, it actually lowers your credit score because you don't have that history reporting on your credit any longer. That's why it's bad to close out credit cards that you had open for years and years. 10% of your score comes from having new credit. That's 10% to the good or 10% to the bad, depending. When you put big new debts on your credit that haven't been paid down, it actually lowers your credit score at first until you've made 6 to 12 months of on-time payments. So your debt to income ratio isn't so high. And then another 10% of your score comes from 3 different types of credit. There's revolving credit like credit cards, which counts 30% of your credit score. And then there's installment loans, something that you have a set amount of payments on until you're done, like a car payment or student loans or a small loan at a bank. That counts 30% of your credit score. And then there's also mortgage credit, which counts 40% of your credit score. A lot of people haven't bought a house before, but don't worry. Just having a couple of credit cards and an installment loan can actually start to push your credit scores high enough to be able to purchase a home. Last but not least, 30% of your credit score comes from amounts owed. So once again, that kind of goes back to that new credit thing. When you put a big new debt on your credit, you actually lower your score by 30% until you get it paid down. Also, if you have a credit card with a $300 limit and you have it maxed out, then you're actually lowering your score by 30%. The best way to use a credit card is to never use more than 30% of the limit. For instance, if you have a credit card with a $300 limit and you don't want to use more than $90 on the card ever, and then you want to make sure to pay it down to 1%. Leave a little bit of a balance on a card. When you leave a balance on a card, it actually gets you an extra 3 to 5 points. 3 to 5 points could be the difference between 1% of interest when you're buying a car or a house, which could actually save you thousands of dollars. What I teach my clients to do is 30 days before you know you're going to make a big purchase like a car or a house, pay your credit card down to 1% and then leave it there. Credit runs 30 days in arrears, so something you do today doesn't show up on your credit report for 30 days. So when you pay it down 30 days ahead of time, then when you go to get that loan and the bank pulls your credit, your score is as high as it possibly could be based off of those credit card algorithms. This is a few different things about credit that I like people to know about. What it takes to buy a house these days. I also like people to know about the FICO scoring model. And then also, we go over credit and the definitions. So let's talk about the different definitions and things that show up on your credit report, like collections, late payments, charge-offs, inquiries, and public records. Let's break that down just a little bit further. We probably know what all of these things are, but some stuff about it you might not know. For instance, did you know that paying off old debt actually lowers your credit score? Lowers your credit score, what? Well, let's go over why. On a scale of 1 to 9, 1 being good and 9 being bad, a collection's considered a 9, a paid collection's considered a 9, settled considered a 9. They're all considered equally negative. Something you did 4 years ago actually affects your credit score less than something you did 1 year ago. For example, if you had a collection from 2018 and you pay it off, now it's a new paid collection in 2021, a new negative thing on your credit and actually can lower your credit score. What you will want to do is not necessarily pay it off or settle it out. The best thing to do is try to get it removed from your credit if at all possible. So for instance, when you call and try to settle out the collection, see if they'll remove it upon payment, especially if it's an old debt, or if you're trying to get something like a house or a car, you will want to try to settle it out before you close on something like that. Just bring proof that it was paid so that it doesn't show up on your credit report and lower your credit scores right before you're fixing to close on a house. The next big thing that I want to talk about is late payments. Late payments actually count 35% of your credit score. A lot of people don't realize that one late payment can actually drop your credit score anywhere from 50 to 100 points at a time. And when I say late, I mean paying 31 days or more past the due date. It's really, really important to pay everything on time, especially when you're in our credit repair program. Charge-offs. The definition of charge-off is dead debt. That is something that was with an original creditor. You stop making the payments. It gets about 30 to 120 days in default. Then they write off the debt. They collect the taxes and or insurance break on it, and typically they sell it to a collection company from anywhere to 4 to 6 cents on the dollar. The next thing you know, it shows up on your credit report. The last thing that shows up on credit report is public records. These days, only bankruptcies show up on credit reports. These are all the types of things that we dispute and try to get removed from a credit report. Of course, if they're erroneous. But if you have any tax liens or judgments, you will want to make sure to get that addressed, because when you're trying to purchase a house, they will find out and you will have to take care of them before you're able to purchase anyway. Okay, so let's recap on all of the things that we just went over. 1, what it takes to buy a house these days, whether it's FHA, VA, or conventional loans. There are 3 different types of loans, so make a decision of what kind of loan you think would fit your situation best. And then make sure to make a plan to be doing the things that you need to be doing while we're doing credit repairs so that you get what you want. Remember, as an extra bit, that you need to have open trade lines. You have to have something open and active on your credit report that's increasing your credit score, like credit cards and small loans from bank or a car payment in order to get your credit score to go up. Credit repair doesn't make your credit scores go up. You have to have open trade lines. What credit repair does is take those erroneous things off of your credit report so that you're taking negative things off your credit report and putting positive things on your credit report. That way, the end result is that your credit score goes up and you get what you want. The other thing that I'd like to recap on and give you an extra little tidbit is about the FICO scoring models versus the Vantage scoring models and everything that we find online. On the FICO scoring model, that's what banks pull, and that's considered a hard inquiry. Whenever you have your credit pulled by a credit monitoring company, that does not show up on your credit report as a hard inquiry. So feel free to get on our credit monitoring system and take a look to see where you're at with things. Just know that you're going to get alerted when things change on your credit report, and that just means that we're helping you with your credit. We have people get signed up with a credit monitoring company. That way we can watch your credit and check your score every 45 days. We actually refresh that credit report so that we can see where you're at with everything, and then we email you your results. This way, you're not getting a hard inquiry. We make sure that everything is working the way that it should be on your credit report. And then last but not least, those simple definitions of the things that show up on your credit report: collections, late payments, charge-offs, inquiries, public records. These are the things that we address and try to help you with the best that we can. I look forward to working with you, and if you have any questions, reach out to our credit coach team and we will take good care of you. We've been around for 14 plus years now, and we enjoy and love helping people every single day.